Hello, everybody. This is Bennett Tchaikovsky, and welcome to Problem 15.5. This is from the Intermediate Accounting 17th edition video solution walkthrough. This is taken from the textbook Intermediate Accounting 17th edition. Authors are Don Kiso, Jerry Weingant, and Terry Warfield. The question used in this presentation is copyright 2019 by John Wiley and Sons. All rights are reserved. This video is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 to 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky and not the authors of the textbook or of Wiley. Okay, so let's go ahead and take a look at problem 15.5. So before Gordon engages in the following treasury stock transactions, its general ledger reflects, among other things, the following account balances. Okay, the par value of its stock is $30 per share. That's insane. Okay, and I'll say it every time, the par value of stock. And let me just go to my point. Okay, sorry. If I go to Meta Platforms, which is another way of saying Facebook rebranding itself after Cambridge. Oh, after going to Cambridge or Cambridge Analytica, I don't know what I'm talking about. Right over here, par value 0.00006 per share. Par value would never be this high. Okay, if you're writing this par value this high, it's April 20th someplace. Okay, so we'll just go ahead and APIC, common stock, 99,000. Common stock, par 270,000. Retained earnings is going to be basically over here at 80,000. Okay, so let's do some backward thinking here. So if my par value is $270,000, how many shares do I actually have outstanding? So my shares issued, shares outstanding, what I would do I would take A divided by 30, which is the par value, and I would get 9,000 shares on each of these. So I have a total of 9,000 shares, assuming there were no other shares outstanding. Okay, so record the treasury stock use the FIFO method for purchase sale purposes. Okay, so what this is, we'll get into a moment what that's referring to. Okay, so if I go over here and I bought 380 shares of treasury stock at $40 per share, what exactly happens? Okay, so let's have fun with this. So I'm going to be debiting treasury stock. And I'm going to be crediting cash. I guess it doesn't really give us any dates. So right over here, bought 380 shares at $40 per share. Okay, so I got 15.2 and 15.2. Okay. So what exactly happens at this point in time? Right? So we'll call this letter A. When I buy 380 shares, right, I'm going to have over here treasury stock. And this is going to show as a negative amount because treasury stock is going to be reducing our owner's equity component. And just to show another example of this, let's go over here to Home Depot. Okay. Home Depot quarterly report. By the way, 5-cent par value, right? Slightly higher than Facebook, but the stock value of Home Depot is right now trading at almost $400 per share. So what is par value? It's the minimum amount that a shareholder needs to contribute. If a shareholder doesn't put in that full dollar amount, there becomes a problem. Okay, so that's, in my opinion, that's a problem. Okay, so, and that's why you show a ridiculously low par value. So, okay, so it's going to show up as a negative amount. And again, if we look over here at the Home Depot, and you'll see that this treasury stock is right over here at 76,293. So this will show as a negative amount. But what's going to happen over here is that my shares outstanding are going to decrease by 380. Note that when I'm dealing with treasury stock, my shares issued are not going to change. Okay, let's go ahead and go to letter B. Next one, I bought 300 shares of treasury stock at $45 per share. So over here, treasury stock, cash. This is going to be 300 times 45. And this is going to give me over here 13,500. Okay. And my shares outstanding, because I'm buying back stock, these 9,000, I'm now taking out another 300 shares. Okay. So we've gone through and we've handled those first two transactions. Now, I sold 350 shares at $42 per share. Now, let's think about this. If they're saying FIFO, what does FIFO mean? It means first in, first out. So what I'm assuming by this methodology, instead of taking an average of these costs, basically what we're going to go through and do is we're going to go ahead and say, okay, we're going to use this as our cost basis. Okay, this should over here be. Okay, so for letter C, what I'm going to have here is I sold 350 shares for $42 per share. So right over here, this is going to be 350 times 42. This was 300 times 45. This was 380 times 40. Did I get that right? Yeah. Okay. So I sold 350 shares at $42 per share. So if I'm using the FIFO method, right, first in, first out. So what I'm going to use is I'm going to use these shares up here to do this. Okay. So let's give ourselves a little bit more room. Okay. So when I sell treasury stock, I debit cash for the amount that I'm receiving, but I'm going to credit treasury stock for the amount of money that I went through and paid for those shares. Now, again, I could either do a blend, but in this case, it's telling me to do FIFO. So I'm going to use $40 per share. So this is going to be 350 times 40. Now I've got a difference here. To balance this equation, I have 700 that I need to balance. This is going to go into additional paid-in capital, treasury stock. So the additional amount after we go right over here, we're showing the cash received using the cost basis from my first transaction, which was from transaction A. And then over here, I've got the additional amount, which is the 14,700 minus the 14,000. So this is going to go into additional paid-in capital treasury stock. Notice over here that when I never record a gain or a loss when it comes to selling my own shares. Very important to remember. So right over here for transaction C, my treasury stock is now going to be increased by 14,000. Remember this, going back to our favorite T account. So liabilities and equity typically have credit balances, right? So over here, these are all credit balances. This treasury stock, when I buy it, it's going to be debited. When I sell it, it's going to be credited. And then over here, I've got additional paid-in capital treasury stock of 700. Okay, let's now take a look. And also my shares outstanding, these are now increasing by 350. Okay, let's go ahead and now take a look at letter D. For letter D, I sold 110 shares of treasury stock at $38 per share. So we're going to do the easy part first. How much cash did I get? Well, I got 110 at 38, or basically for a total here of plus 110 times 38 per share, or 4180. Now, this was for 110 shares times 38. So when it comes, though, to my credits here for the treasury stock, what do I need to do? Well, up here, I had 380 shares. I assigned at 40. I've already assigned 350 for these. So for the treasury stock, what I'm going to do is I'm going to do 30, okay, at, which is going to be 380, letter A, minus 350, letter C. And I'm going to multiply that result by my cost basis from letter A. Okay, so this is going to be 30 times 40, or a total of 1,200, but I'm not done yet. So I've now went through and I've exhausted under FIFO, right? So I now have costed out these 380 shares. Now I've sold 110, I've costed out 20, I need another 80. So this is going to be 80 at 45. Okay, so 80 shares. This over here is going to be 80 shares, okay, at 45. And this is my cost from the letter B. Okay. So when I go through over here, so again, treasury stock. So when I come over here, I've got 4180, and then I have 4800. So when I look over here at my T account, the way I handle losses are basically when I sold, I know I'm going to need a debit to balance this out. The way I'm going to handle losses is I'm going to go over here to additional paid in capital treasury stock. Additional paid in capital treasury stock from transaction C had a balance of 700. So what I want to do first is I want to go ahead and exhaust that amount. So over here, I've got 620. So I'm going to go ahead and debit additional paid in capital treasury stock for 620. And when I add these two up, I'm going to get to be the 4,800. Now, what would happen? So right over here, letter D, my treasury stock is going to be increasing by 1,200 plus 30, base, that's the 4,800. My additional paid in capital treasury stock went down by 620. And then over here, my shares outstanding are now increasing by 110 because those are now back out in the marketplace. But what would have happened here if I would have sold the alternative, sell the 110 shares for, let's do it for 20 per share. So if I did this, so again, this is not part of the question, but had I gone through and done this, let's just kind of go through and do this. If I take 110 times 20, I get 2,200. The amount of the treasury stock over here isn't going to change because I'm going to be doing this at the cost. Okay, so this is going to be 110 at 20 per share. And again, this is not a part of the Wiley textbook. I'm just doing this to illustrate a point. So now I've got a situation where I've got 2,200 and I've got 4,800. What do? I need debits to balance. So what I'm going to do here is I'm going to do additional paid in capital treasury stock. But when I debit this account, the most I can take is I cannot go have a debit balance and additional paid in capital treasury stock. So what I'm going to do here is I'm going to take 700. What that's going to then give me is I'm going to now have a total of 2,900. When I subtract this out, I need another 1,900 to balance, and that is going to go to retained earnings. So if you have a situation like Jim Tanning and Laundry or Mike Sorrentino on that Jersey Shore, If I have a situation, I'm dating myself. If I have the situation, parents went away on a 2-week vacation, left the keys to the Porsche. I think that's Fresh Prince. But right over here, if I have a situation, okay, a serious situation over here, what do? Okay, I figure out how much cash I got. What was the cost of those treasury shares? I then deplete additional paid-in capital till it goes down to 0. And then the remaining difference is going to be going over here to my retained earnings. So if that situation pops up, that's what you're going to go through and do. And just give me one moment. Perfect. And we're all good to go. So I want to thank Wiley for allowing me. Where's my thank you, Wiley thing? Here we go. Thank you, Wiley. Please don't forget to like and subscribe. And if you'd like to see other solutions, please feel to ask for them. Feel free to ask for them in the comments to the video. So again, thank you for joining me here today. And I look forward to seeing you on the next video. Have a great day.